We put together a couple slides. We want to frame similar to what we've done in the past, kind of walking through the equity market in general, what we're kind of seeing and noticing, and then the opportunity set that we think is pretty interesting today. So this first slide is highlights the monthly U.S. uncertainty index, looking back the last 25 years. We introduced this one earlier in the year. And again, if you go back and look the last 30 years, COVID 2020 was the previous high that was eclipsed by the tariff fears back in April when we went up to a level of 700. And we saw the reversion back to historical averages. And we think that's going to similar follow that path as we look forward to 2020, 2021. So it's possible future tariffs could have a short-term impact, but we think the long-term trend of uncertainty actually falls lower over time. Leadership that we remember, if you remember going back to 2020, 21, you initially had long duration equities. Technology companies did well coming out of COVID. That was actually eclipsed by small cap and value late 2020 into 2021. So we saw early signs of in the market starting to broaden in Q3, and I think as we look over the next 6 to 12 months, we would expect a similar trend to kind of play out. If you go on to the next slide, here, we've discussed in the past concentration in the market, and it's really interesting when you start peeling back what's actually the indices and just thinking about, buying the S&P 500. So if you look on the left, the chart on the left side upper box, the blue line's the S&P 500. And so we can see looking at that line, the pullbacks to 2000, 2002, and 2008 and 9, but the long-term trend has been up and to the right for the past 35 years, and obviously, as we know, longer, as the market is up nearly 70% of the time, as Bill 3 used to discuss in the past. The red line, if you look at, which is equal weight versus the S&P market cap weight, when the red line's falling, top market caps are significantly outperforming the rest of the market. We circled in orange on the chart when this occurred in the past, which is the late 1990s. And if you look at the bottom portion of the chart, which looks at concentration, top 5 is in red, top 10 is in blue. You can see how the peak concentration back in 1990s coincided with small pack equal weight relative to market cap weighted actually lagging and troughing. So if we look today, we think we're in a similar time period. The top 10 now is over 40% of the S&P 500. So I think it sets up for significant broadening opportunity in the market over the next couple of years. David had mentioned the intro, the chart on the right, which looks at the S&P 500 market cap, which is greater than 10 times revenue. This subset, we know from past history, all different return streams have been looked at. It significantly lags the market over time. High expectations are hard to actually deliver when you're in that high of a valuation level. Over the past 60 years, it's rare to be over 10% of the S&P 500 weighting. So if you go back and historically and look at that, you can see the dot-com peak where you were at 25% of the index in long duration equities. They significantly underperformed over the following 31 months, going all the way back to where it was almost completely wiped away. In late 2021, we approached 25% before a sharp pullback back to 10% or below 10%. And so as we look at where we ended the quarter, we're now approaching 35%. So the longest duration equities, in our opinion, look pretty overvalued, especially when you start comparing valuation spreads to low valuation and smaller market caps. On the next slide, we look specifically at what's been driving kind of long duration. And this next slide that's coming up looks at technology stocks and the S&P 500 technology sector. And we look at price to sales because one thing that's missed a lot, I think, by the marketplace is cyclical companies, peak earnings, peak valuation. It's even greater risk when there's a disappointment on margins contracting, earnings and cash flow resetting, and then valuation contraction on top of it. Price to sales is good measure to look at historically for cyclical sectors, and so we can get a sense as what the technology sector looks like historically versus where we're sitting today. Historically over 6 times revenue. It's rare to see that. We were at 7 times during the dot-com bubble. It peaked at 8 times in 2021, similar to the chart we looked at before, and today we're approaching 10 times. You can see by the dot that's above that, that's the S&P. That's actually the Magnificent Seven, which is at 12.5 times revenue. So again, I think we're sitting today at a point in time where it's interesting that those companies, which historically were capital light, are transitioning to more capital intensive businesses. So again, potentially being a risk of future free cash flow and maybe not leading up to the expectations of what the market's actually assuming today. The chart on the right looks at the difference of the sector weights of the S&P 500 versus the sector earnings contribution. On the left, financials, which you can see is plus 6%. So the S&P weight in financials is 13.5%. The earnings contribution is actually closer to 20%, over 19%. Let's go all the way to the right. Again, not surprising, technology sector. The weighting is 34.8%, much higher, 11% higher than what the earnings contribution is. It's worth noting that the tech sector in 2000, March of 2000, peaked at 34.9%. And we know going back 18 months later, at the end of 2002, the weighting was close to 14%. So again, equities approaching peak margins, peak valuation multiples. There's high expectations. It makes them vulnerable to any kind of valuation contraction or rebasing of that earnings and cash flow if there's a disappointment on future expectations. The next slide, which is where we kind of lead to us being really excited about the market. It's in plain sight. We think it's being overlooked today. What we've done is we've set up a chart here to look at taking different slices of the market, looking at different equity classifications. The first column, and these are looking at valuation multiples for each row, but the first column is the S&P 1500 Growth Index. The price to earnings multiple looking out 2 years is 26 times. You can see the price to book above 9 times, cash flow multiple over 30 times or near 30 times, enterprise value to EBITDA of 23 times. Not surprising, looking at the last row, the technology weighting is greater than 40%. Second column is the S&P 500. Today, because of concentration, top holdings, and longer duration equities, it looks more like a growth index. If we went back historically, it's not diversified as one would think if you're buying the S&P 500. Even the S&P 1500 value, which is third column, has valuation multiples that are approaching the higher end. We're surprised to see that Apple and Microsoft are actually the two largest holdings in the S&P 1500 value. As we know, both companies are above 30 times earnings, and you can see the tech weighting of the S&P 1500 value at 24%. So as you move now to the right, what's interesting is the 1500 pure value, so that's the lowest valuation subset. Look at also the lower market caps. The S&P 400 is the mid cap index, and the 600 is small cap. You can see how the technology representation falls to the high single digits. More importantly, look at the valuation measures, 40 to 80% below the market. So again, as Bill highlighted earlier, the crowding in AI technology companies, it's creating significant risk to passive investors just if you're going to invest in the indexes, given their significant cross ownership between the investment classifications. Investors, if not exposed to lower market caps or lower in valuation equities, you're not diversified in our opinion today. So we think it's a pretty interesting time to look there. And while the S&P 500 is near all-time highs, we see mispriced equities, single-digit valuation multiples, earnings free cash flow yields that are multiples higher than the market in the 10-year bond. On the next slide is the final one we have in the market. We just want to kind of revisit quickly just the small cap market. And it's a little bit hard to see on this, but if you look at the upper right-hand corner, it's small cap rolling returns in red versus the S&P 500. Beginning of this year, we were at a 500 basis point annualized lagging of small cap versus large cap, 90-year trough. Last time we saw those were early 2000. Again, that theme of coming back to the early 2000 time period. And we know small cap dramatically outperformed large cap the following 7 years coming out of the 2000 trough. For small caps today, it's very similar to equities versus bonds during the lows of the Great Recession. If you remember back then, equities 10-year trailing returns were below bonds, led some to question kind of asset allocation in general. In our opinion, and we all know how well equities did versus bonds, since the Great Recession lows. The lower left chart looks at the Russell 2000 within the Russell 3000, and today we're near an all-time low, 4%. It's half of the 30-year average. That's closer to 8%. The top five names in the S&P 500 combined make up their market cap is now more than 5x the entire Russell 2000 market cap. 10 years ago, the top five were only 1.5 times. Just shows you how much, again, concentration of market cap in the equity market is on the top holdings. And chart to the right is what we think starts to make why this is different as we look forward. You're coming out of a 2-year earnings recession for small caps. So their earnings are expected to inflect. They're expected to be greater than large caps during 2026. They should benefit from lower interest rates, further deregulation, and there's expectations for about 150 million in the tax savings early next year for consumers for the tax bill that was passed. And so we think there's a potential for further kind of small cap earnings to have tailwinds as we go forward. In addition, if you looked at valuation spreads, which is not on this slide, but small cap value versus is at the single digits decile versus on a historical basis, which again, relative to large caps, which provides an opportunity for valuation expansion.